I will say that managing assets through the financial crisis was one of the most intensely stressful and scary experiences I've ever had. If you have confidence in yourself and you have confidence in the markets, you win 9 times out of 10 in the stock market every single day because you are betting on the ingenuity of the smartest people in the world worldwide to figure it out.
Well, today we are honored to have Heather Loomis Tighe, the founder and CEO of Loomis Capital Management, with us. Heather serves as the Chief Investment Officer for significant family offices. Before founding Loomis Capital Management, Heather was a partner and managing director at Glen Capital, a notable Silicon Valley-based venture capital and technology investment firm. She also held pivotal roles at BlackRock, where she was managing director and head of institutional family office businesses for the Western United States and Canada, and served as the market strategist for BlackRock's institutional business across North America. Heather's impressive career includes 12 years at JP Morgan, where she managed a $13 billion fixed income business and founded WISE, the Women's Insight Series and Education. Heather, we're thrilled to have you here today and chat with you. Welcome.
Yeah, welcome.
Thank you so much. It's so good to see you guys again.
So
Likewise.
Good to see you. How's the weather treating you where you are in Wyoming?
It hasn't snowed since June, so we're happy about that. And it's been a wonderful summer.
Is it the couple of months where you don't have to wear 2 jackets or lots of layers?
We're in the 2 to 3 month period where I don't have to wear a jacket and snow boots every morning.
Hey, that's a win.
We'll count it.
Yeah.
I call that area God's country. It's got to be some of the most beautiful area. I mean, Jackson Hole, Wyoming is amazing. So yeah, we're jealous, but we live in San Diego, so we're not complaining.
Yeah.
No, there's no shortage of perfect places, but we definitely feel a lot of gratitude for the place that we're in at this point in time.
For sure. So given your impressive background and experience, tell us how you got kind of going down that path and how you got started.
I wish I could tell you that it was a very planned, methodical career path that I had envisioned. But in reality, it started at university, and I was an English major. I was kind of thinking about learning more Spanish. I was taking enough ballet classes that I had a ballet minor. There was no economics, no finance in my world, so to speak. And at Duke, they had a policy where you had to take classes in different disciplines. And so I took an economics, it was probably an economics 101 class, and I sat in it, and it was as if the world became clear. Understanding the basics from just how the stock market works and operates to supply and demand, a combination of macro and microeconomics, but explained in very simple terms where people who had an intelligence level, but not experience in economics and financial markets could understand. And I fell in love with it. I fell in love with the efficiency. I fell in love with how much sense it made. And that was late in my junior year. And so I pivoted at that point to just taking more and more economics classes. I went to London. I studied at the London School of Economics over a summer, trying to catch up with everyone else who'd been studying. What I failed to do, because I had gotten into it too late, was start that path, because the path of finance starts really as a sophomore and junior, where you start interviewing and then interning at Goldman Sachs, at JP Morgan, at what was then Lehman Brothers when I was in college. And so I did a different track. I used connections. I was kind of scrappy. I called everyone I knew. I asked for internships. I ended up interning in Hong Kong for my big sister and my sorority's father. And it was amazing. What an amazing experience.
How long were you in Hong Kong?
I was in Hong Kong for the whole summer.
Okay.
I learned about international lines of credit and, because a lot of it was in the manufacturing business and dealing between, interbank issues and money transfers. It was a different aspect of finance, but very quite valuable and really interesting.
And was that your intro into like international trading or business? That was kind of a first experience for you?
It most certainly was. I had proceeded a little bit with some microeconomics work at the London School of Economics, but that didn't really get me into the world of business. It was more of the theoreticals of business. I mean, this guy had a chalkboard and he started one equation and it just kept going and going and going. And they would flip the chalkboard up and another one would start. I was really, I spent a lot of time in that guy's office. My head in my hands, like, what?
Yeah.
But no, it was a fantastic experience, and it broadened the aperture, outside of the confines of college and then the United States, and looking into these different geographic zones. But I will say, when I was entering into, I think it was either my junior, I think it was senior year, and looking to officially get a job, everyone who had interned and done like the prerequisite internships at these big institutions were sitting pretty with their job offers. And I was really just starting, because the place I interned in Hong Kong wasn't really a track to a permanent job. It could have been, but that probably wasn't what I wanted to do full time. But right before I started applying to jobs, 9/11 happened. And I went to the career fair. I remember this as a distinct memory, with 100 copies of my resume. I had gone to the printer and printed them all out. So I had this stack of resumes. And I went to this career fair, and there weren't very many people there. But I tried to hand out my resume to every booth that was there. And they all were like, "Ooh, we're not hiring. We're just here to represent our presence on campus." There was only 2 organizations which were accepting resumes, and one was a hedge fund based out of New York. I gave them my resume. They took it. And then the other was the CIA. And
oh, no kidding.
they tried to give them my resume, and they said, "Are you a graduate student?" I said, "No."
Yeah.
They said, "Do you speak Farsi?" I said, "No."
Yeah. Oh my gosh. You're like, "No, I didn't learn that. I learned Spanish actually in my minor."
Like,
Un poco.
But I had dedicated 1 full hour to this career fair, and I spent probably 3 minutes there. So I had all this extra time. So I started talking to the guy from the CIA. I'm just asking him questions, because after I'd interned in Hong Kong, I traveled around Hong Kong. I was in Thailand, and started asking him questions, about the Burma border, just different things that were going on in the world. I think I probably annoyed this guy to death. That finally at the end, he said, "Listen, I'm going to take your resume." He was like, don't say that it was me who let you in, but if you get in through the process, you get it. So I said, "Great. Perfect. Hey. Wonderful. Off to my next class."
Yeah.
I had 2 resumes in. So as I graduated Duke, I had 2 job offers, one from the trading firm and one from the CIA. I ended up getting both job offers.
Way to go.
Yeah, it was a miracle. It was actually a miracle that I got through all of the testing in Langley, which was as weird as people say it is.
I bet those were unique interview processes, to say the least.
Oh, correct.
Yeah.
Yes. Very psychological. And so I kind of had at that point to make a big decision, like which job was really for me. And ultimately, I thought in the aftermath of 9/11, I really made a personal choice that to work for the CIA at that point, I thought there was a good part of my work that could go into some form of retaliation, something that I wouldn't know what I was working for an end to. And I ultimately didn't feel comfortable with that being my life's work, just not knowing what I was working towards, as would be expected as a junior member of the clandestine services. So I took what I thought was the least risky job and joined the hedge fund, where I was their, I guess I was their second female hire at the firm. So it was also a very unique experience. But to make a long story longer, it was there where I learned to trade. I learned to trade public equities, and it was there where I really gained, I would call it, a very deep respect for markets. you guys know, like living in San Diego and being adjacent to the ocean, you have to have a very deep respect for the ocean and how powerful it is, and how when the ocean turns, what it could do, what it could do to people. And, you have to be very aware of your surroundings at all times. And I think that is the kind of the education that I got as a trader in the markets, like feeling the pain when the market turns against you, and when you're shorting a stock and it goes the wrong way, or, the opposite.
And whose money were you trading at this time? Like was it a fund or a 401k?
Great question.
So if you lost money, who were you affecting?
I was on a prop desk. So in that situation, it was the firm's own capital. Okay. So effectively at this firm, I was trading the firm's capital. So it was the partner's capital. Okay. And so at the end of every night, you had a profit and loss statement of what you made, what you lost. And it was very interesting. A lot of the people who they hired into the specific organization were very specific athletes from very specific schools, because they felt that the gene of being able to trade, and like that stomach for trading, that kind of mental toughness, corresponded with those same attributes that you would have if you were a D1 athlete. I was not a D1 athlete. Was ballet minor. I was not a D1 athlete.
Well, ballet, you got to have some, athleticism too. Yeah.
Athletic, but honestly, I was really taking it more for exercise than anything else. Like I couldn't even call myself a ballerina. It was more just a byproduct of having some extra time and continuing just some, I would say, athletic courses. But yes, it was. But I would say there was one moment where I was trading, and you had a number of screens, right, up at any given time. And I think I was trading some consumer. I think I was trading Michael's stores at the time. And I remember the senior trader sitting next to me turned all of his screens to the bond market. And at that point, I was an economics major, but I didn't really understand the inner workings of the bond market. And I was looking at him and I thought to myself, Daryl, what are you doing putting all your screens to the bond market? Your positions are moving, And he made this kind of like off the cuff comment, like kind of to brush me off, because he was really concentrating, because I think the Fed was about to announce. He was like, the bond market's the smarter market. You watch the bond market. And I said, what did you say? The bond market is the smarter market? And then I'm thinking to myself, well, what am I doing trading the equity markets? If there is a smarter market that I could be trading. And so I didn't really pay too much attention to it, but it was in the back of my mind. A couple months later, I visited a friend from Duke who had moved out to California. I stepped foot in California and I thought to myself, oh my gosh, what am I doing living in New York City? Look at this place. I remember standing at the top of the hill in Pacific Heights and looking out at the nearly 360 degree views of the ocean in the city, which had really been like left for dead after the tech market crash. So it was empty, cheap rents, tons of natural beauty, but still a great deal of young people there who were educated and fun and hungry. And I made the decision to move to San Francisco right then. And so this kind of continues this career path that was not necessarily planned. It was a little bit haphazard, but at every step along the way, I genuinely learned, different things. So I ended up interviewing for a job in San Francisco. I interviewed for all equity trading positions, but then I took a filler interview, just kind of like a backup interview at JP Morgan at the private bank at the time. I was like, I'm not going to get a job at the private bank. I'm not going to take people to the ballet. What do I know about, bringing in the billionaires? I'm just a kid.
I've just been trading, stocks in the New York market. I mean, that's
exactly. I can tell you where Michael was trading today and what my thesis is on that, but I certainly couldn't, lure anyone into my orbit. And so I met a group of people and I ended up meeting the gentleman who ran the bond business at the time.
Oh, he said, I know bonds.
Yeah. Well, I was like, oh, bonds. So you trade the smarter market, eh?
Hey.
And so we ended up getting along just on a personal level. It was, I think by virtue of the fact that I thought this was a filler interviewer, my demeanor was quite relaxed. I didn't feel a great deal of pressure. So the conversations were more fluid. It wasn't, I wasn't very nervous. So we ended up having a very good rapport. And he called me after the interview and said, I know you applied for a job, in this kind of junior banker role, but would you like to come and work with me and learn the fixed income business? I said, well, that's an interesting proposal. I have to tell you, I have to admit that I know not one thing about fixed income. It's okay. So long as you know. And so that was what got me into my 12 years at JP Morgan, where I started, and I ended up taking over the fixed income business 6 months before the financial crisis. So I think that when you think about how you both and I met, that has really underscored all of my education on risk management, and how to properly structure a portfolio, and the need for assets which are non-correlated in a portfolio that do one thing when the rest of the market is doing another. Because I will say that managing assets through the financial crisis, life to date, was one of the most intensely stressful and scary experiences I've ever had. To watch fundamental systems crumble in a matter of months before our eyes, and everything you held as a given, down to money market funds remaining, a store of value, was tested and broken during that time period. And so it on top of that kind of like healthy respect I learned from trading equity markets, you also have to layer onto it a very heavy dose of risk management. And again, it was part of that respect, but you could see how when markets begin to test things, they test absolutely everything. And they always take it 1 to 2 steps beyond what you think is reasonable. So if you move your curve of like what your standard deviation of risk is, assume that there's probably a couple more standard deviations that you could go out before it ends. And that was trading bonds in the financial crisis. And so,
wow. And you were still at JP Morgan at this point.
I was. And it was really in the aftermath. And I think that, and it was a very hard time. Like we had clients. I think in general, we did a very good job. We kept the portfolios, very well managed, but there were, of course, there was no ability to sidestep people losing money during that period of time. And it was, I remember being deposed in a court in Los Angeles as the person most knowledgeable about bond markets, and even that, like, even just going through that process, and of course we ended up being in the right, not of course, but we ended up being in the right. But it was, that experience and just how far things could go when things go wrong is
what did the bond market do right then? I'm just curious.
Yeah.
I couldn't pull that up online.
So Fed funds rates collapsed down to 0. And this was before we actually began quantitative easing. So very safe bonds, call it US Treasuries, some extraordinarily high quality munis, appreciated in price tremendously. However, the investment grade corporate bond market, which housed all of the financial names, all of the banking names, there was defaults there, and there was defaults in what was the investment grade bond space. And so there was a number of pieces of the bond market that completely cracked, and it did not serve its role as a counterbalance to risk. So, people hold bonds as a counterbalance to the risk of the equity markets. So as equity markets ultimately plunged 50%, if you were holding components of the bond market, investment grade corporate bonds with what at that point had a huge concentration in financial names, you were not counterbalancing it. You were going down right alongside stocks. And so it was this feeling of helplessness where there was truly nowhere to go. You usually tap your bond portfolio when that happens to be able to take money out as prices appreciate in bonds to put them into stocks, but you couldn't do either. So it was very hard. And, in some pieces of the bond market predominantly, even defaulted bonds recovered decently, but it took a while, and you did not recover your money at the time where you would need to, which is, I call it the nadir in the equity markets, where you want money to put it.
Yeah, you would have shifted gears and moved some money around to compensate. Yeah, and you couldn't. Yeah,
exactly. Like I was just talking to someone yesterday. I was just talking to a client yesterday, and they were saying, well, what do we do? What do we do in this market if things get worse? I say, we've prepared you. You have very safe investments, which are appreciating right now on one side. You have equities, which are falling. We already adjusted your equity levels before this to make them probably as low as I feel comfortable running at a run rate. And here we now wait. And then we put in levels, and we're going to be buying XYZ% down. Another, we're going to be buying as this market falls, and we're going to be funding it from the other components of our portfolio, which are either appreciating or cash flowing to do that. And so you want to be able to go into something that's rockier with a plan, with cash, or with things which are appreciating. But in the financial crisis, that really that was harder. A lot of people were in a pickle.
So how'd you get out of that? What changed and pivoted to then catapult you out of that? Was it just time or?
Time. The stock market, once it hit a bottom, it started rocketing back. Bonds are a little bit slower, but for the vast majority of our portfolios, they had actually done well. So in some ways, a lot of the clients that I had during that time, I'm still very close with, because it's like the Pavlov's dog association, like in a time of distress, you were kind of like the life raft, but for some of the portfolios that had a good deal of corporate bonds, that took some time to recover. But I think I had personally, just after going through that, like a mentality shift in the way I dealt with clients and spoke to them, because before I was only 28 years old when the financial crisis hit. So I was young to be managing that level of assets and kind of like that level of pressure. And so how I compensated for that was almost being as robotic as possible. When I'd get on the phone with the client and say, this is your duration, this is, just trying to be as accurate and as, knowledgeable as possible.
And bring them certainty.
I ended up sounding like, maybe a robot, some like AI portfolio manager on the other end, telling them what was happening as opposed to a person. And so something kind of like, I think, I wouldn't say like something changed inside me during the financial crisis where I was like, I think we need a little bit more just humanity brought to this space, because it felt so cold and so scary and so arm's distance that when I would get on the phone with clients, I would start with, how are you doing? How are you, what's
realizing it was a real person on the other end of the phone. Totally. And, let's just talk about this as normal human beings. Yeah,
exactly.
Yeah.
Or like, how's your own business going? Like, I understand this is a component of your wealth, but your own business is really where things are, and I would say that was such a turning point in my career. It's almost like after you go through hell, you're able to come back. If you're able to come back on the other side, you're usually changed. And so I was just work. I kind of made the mental decision after just such intense stress, such intense, just feeling awful for so long. I was like, I can't let my work life, I can't let the majority of my hours here on earth be this tense, this uncomfortable and not fun. I have to figure out how to like make these connections with people and just make these hours more meaningful to me. And truly, I would say that was the beginning of Loomis Capital Management at that time, because those people who we're talking with are now my clients, who I established those relationships with. And it was really like, they would ask me questions and sometimes I would say, I don't know the answer, or I was wrong. I would give up trying to sound like the smartest person who knew every single thing about their portfolio at this young age, just trying my hardest not to be found out that I was young or, didn't have as much experience as someone else. And I just replaced that with just kindness and honesty. And that was really not like I was dishonest before, but you know what I'm saying? But just
you led with it.
Yeah. Well, and you had amazing resources. So like, even when you didn't say, well, I don't know, let me help you find out. Like now you can go to your advisors and your resources and your people that to help find the answer, which brings so much more value to both you and your client.
Yeah. Transparency and honesty is always best.
Yeah.
That's part, even after I left, those big organizations with, hundreds of thousands of people who are so smart. I have kind of collected my people who are experts in different niches so that I could maintain that. And I've kind of collected them over 25 years, and you guys don't know it, but you're part of that. You have very deep expertise, in a certain area, and you sense things and you feel things that could be canaries in the coal mine to the next cycle, to the beginning or the ending of the next, of the cycle. And I think those people are so important to have in your orbit, because I think it's impossible to be a deep expert in everything.
Right. I mean, none of us.
It's almost dangerous, the people who do say they are, because they get over their skis.
Yeah. Yeah.
There's too much information.
Yeah.
Like you gave me the best feeling of a rush when you talk about the ocean, because I've been in big surf, and there's just certain things, force of nature and and God, whatever you want to call it, but you don't mess with. There's just too much information. I feel like that's where it's gotten now with the internet. It's an ocean of information.
Exactly.
To where it's like, you don't mess around. And Jen and I have recommitted in the last couple of years to focus
and stick to
our lane, and,
knowing mobile home parks.
I 100% agree with that.
Yes.
When young people are like, what should I do? I'm like, you could do whatever you want, but just get smarter than anyone else around you on a topic. There was this one guy who sat on the analyst desk at JP Morgan. I won't give away his name because he's still a really good friend. I respect him so much. But he was in Texas, and he ended up learning, I think as a young analyst, so the youngest person on the trading desk, he just focused on derivatives and understanding fixed income derivatives and that market, and going, every time he masters something, he'd go deeper and deeper and deeper, to the extent that managing directors on the desk would defer to him. They would put him on phone calls. It wasn't everything, but when they had a question about that, he was on the phone, and he ended up having a career path which exceeded most individuals at his level because of that in-depth expertise. He wasn't trying to boil the ocean. He just knew exactly what he needed to do, but you could build on that, with every year, with every month, you could build on that. So just like you guys have, your area of expertise, even though you keep it focused, your aperture keeps widening and widening as you see more, as you learn more, as you do more deals.
100%. Yeah. Yep. And then I ping and call and to have conversations with people in a bunch of different industries, so that you can kind of get a read on what is going on the consumer side versus okay, what are the big institutions buying in multifamily? And, you just kind of hear what's going on, and then you can kind of paint a picture. And then the volatility, but then also the focus shift of where people want to be, whether that's the origination of debt and where they believe the asset will perform. We're in this weird debt cycle. So it's pretty interesting right now. It's fun.
I think it's so, you're making me laugh a little bit, because I sat down at a cocktail party last night, and this, someone invited me, and we were sitting down. We barely have had a sip of our drink. I turned to the woman, because she's in venture capital, with a firm based out of Asia. I'm like, I tried to do this as casually as possible. I'm like, so what do you think of the economy right now? She's like, Heather, we're at a cocktail party. I'm like, I'm sorry, I can't help myself.
You're like, it's crashing. This is big news. What do you mean?
Like, come on, I'm like, just engage me. 5 minutes. Just tell me your perspective. Yeah. I did the same thing. We were our kids were making dumplings at my friend's house, and she runs. She's a business, which is more in fashion. I said the same thing. I'm like, so what's going on in business? And I try to get the pulses, because it makes a huge difference. What's the consumer doing? Are they tapped out? Because that's going to have a knock-on effect to nearly everything, from employment to corporate earnings to, So I don't know. I do try to ask everyone. And I think that's part of, I think when I think that's a big differentiator from people who are in, you could kind of tell people who are in a business because they're trying to make money, or, they need a job, or people who are in it for just a straight love of the game.
Yes.
They be doing it.
I love that in that article. I couldn't agree more. And then I've been told man, you just love the game. And I'm like, yeah. And I think the game can be, in the end, beat. You know, not I mean, what's that level, right? There, you get to the top of the mountain, and you're like, oh, there's a whole nother level, but it's fun. And that's where I 100% agree with you. And people that get like egotistical, it's like, because that they make it to the certain level and then they're the shit. And it's like, no, you got to back up. And one of my other friends that we're going to bring on next week, he's like, you're always a 6. You're never better than a 6.
Because you always tell yourself you're a 6. Because if you're a 10, well, that doesn't work. How can you get better? And so it's like, no, even if I think I'm at the top of the hill, I'm still a 6. There's another peak over there. I can climb that one.
Yeah, I know. It's kind of like the practice of yoga. You're never going to be in that. You just keep going. Like you just keep practicing it. But no, I love it. And I think that there's people who truly like money is not their end goal. It's just, it's like, it's figuring things out. It's being at the top of whatever game you're at, and then elevating that game. And I think it's this, and I think that lack, when you're not attached to money being your outcome, but being your version of successful, or
opening those doors, right? To like know where else can I play with my money? And like you just said, the focus isn't on like, oh my gosh, I lost 100,000, or, you're not focused on how much you're gaining or losing. You're focused on how many other places can I potentially play and strategize with, right? Yes. To like learn more, to expand my knowledge and have some fun and grow some money at the same time.
Totally agree. And like the people who know the people who kind of like do this with a love of their game in their gut, they are never worried about taking risk. And taking risk is one of the most important things in the world, because it allows you to see the next level, right? Like it allows you to get, but it involves leaving a comfort zone, and it involves the possibility of actually losing. But like the people who don't care if they had to do it all again because it was fun all along, they don't care. And I feel like I'm one of those in some ways, because there's some days where I'm like, I'm like, if I lost everything somehow, some bank glitch and, everything, every account went to zero, whatever it is, So I'll be like, what would I do? I'm like, I would be the best Starbucks barista there is. I would make, and then I'm like, and then I would get promoted, and then I would probably talk to some people and then get another, like, it's almost like, then I'm like, wait a minute, Heather, would you be more happy being a Starbucks? Taking this like fantasy level.
You'd work your way up in the barista realm and build Loomis Capital all over again. So
Loomis Capital, like cappuccino machine.
Oh my gosh, I love that. So that's a good question, right? Like knowing what you know today and all the experience that you've had, like how would you, teach your kids or some, a new client that doesn't know a lot, like how would you advise them or teach them to strategize and to diversify? And what asset classes would you maybe point them in, in a portfolio?
Well, break it into 2 parts. Like what I teach my kids are 4 and 7. So they don't,
well, maybe when they're older and can understand it, right?
I do teach them that they have to like, I tell them all the time, like, I can't just buy that for you. Where will I get the money?
I know. I tell my kids that too.
So we kind of try to lay the framework of that, but he's like, just do it on Amazon Prime. And I'm like, but Amazon Prime costs money.
Yeah.
What do you Amazon Prime is just a free marketplace where I get things from.
Just hit go, the yellow bar button.
What is the problem, Mom? You just hit the button.
It'll show up at the front door tomorrow. Yeah.
This is I'm like, oh boy, we've got some work to do here.
Yeah.
But for my kids, I'm more like, the only things that I could say contributed to like any level of getting to that 6, in my life was just working really, really hard. Like the front half of my life was just working really hard, but also at the same time being like, trying to be as kind as possible to others, because the people who were kind to me or who I was kind to, not for any end, not to any end, just for the sake of it itself and just for a human, they are my clients. They are my best friends. And, these people have spoken at my wedding. These people are clients who have showed up at my children's baptisms, like these people who you were just exercising a level of kindness and humanity with while working hard, it's really the perfect combo. And it never leaves you feeling dissatisfied, no matter what you do. And apply that to anything, not finance, but any job, landscaping, doctor, whatever it is. I think that there are parallels. So that's the only thing I tell my kids. Like, I don't care really about anything else, how well you do, so long as you're kind and so long as you actually try.
Yeah. And I feel like we're going into the era of pure opportunity. Like, it's kind of amazing. Like, I have buddies that are spinning off, becoming their own plumbing companies, electrical companies. Yes. And it's like, dude, if you just had worked hard for a while and look and learn from somebody that has built something really cool and made a decent living, the sky is the limit right 100%.
Now.
100%. Completely agree. Like,
it's unreal.
I loved college, but I'm almost like, my son really likes putting things together on robotics. And I genuinely would be like pushing him towards more of a technical school education, not pushing him, but you know what I'm saying? Fostering that if that's what he
support that, if that's what he wanted, for sure.
Yeah. I don't see any value in following a linear path that someone else took just because it worked for someone else. And it's just more of, but going on to asset allocation. So growing up in the bond market, I have a slightly more conservative orientation than I would say most asset managers, because the statistics of the market are over such a long period of time, and it doesn't take into consideration the fluctuations of people's lives and also of their mentality, of their ability to stay in something when it gets scarier and absolutely terrifying. I saw so many people sell their equity portfolios within 3 days of the market bottom in the financial crisis.
No kidding. Right? How long does it take, or how long did it take then to get to bottom? While, right? Or was it quick?
It was pretty quick. I could have been from like the beginning to maybe 6 months. I don't know. I go look at the chart, but it was like they endured so much. But it's right before it gets darkest. That you're like, I can't do it. I think they're like, I can't do it anymore.
Oh man!
And then once you sell there, you need to make so much to get back to the level that you were at. And if you stay out of the market, they would stay out for a year, waiting for it to come down again, waiting for the next shoe to drop, and then finally they get back in and call it after everything's recovered. And it will take them it'll take years and years and years.
Yeah. Like,
depending on,
borderline a lifetime. That's why you have to stay.
You have to stay in, but you have to have this balanced asset allocation. I think so.
Yeah.
I think you have to have a big piece of your portfolio, which truly you feel very comfortable with. And I call that, I generally call that bonds. I actually like municipal bonds for individuals who pay taxes, because there are tens of thousands of issues of them, different ones. Many of them are tied to essential services. So even if you get, you didn't get a bonus this year, you may not spend as much money at Target or, on Amazon, right? But you're going to turn your lights on in your house and you're going to shower. Usually those things aren't going to go by the wayside. So those essential service revenue bonds stay very consistent, because those are things which need to happen if you simply are alive, right? It has nothing to do with your spending, how, you're going to buy a new car, put that off, whatever it is. And so to have that as kind of a ballast of the portfolio.
What percentage would you say would be the ballast?
I would say a minimum 25%, depending upon your age, depending I like to have a fairly large percentage of the portfolio in bonds, because there is a science to it, and the science is when the market falls, even though the market falls, categorically not that often, it is rising far more than it falls. But you have that dry powder to allocate, and to allocate and buy when prices fall, the holy grail that you can buy low, sell high, buy low. Most people are doing it in reverse. It's just psychology. They buy when things hit a frenzy, like,
get excited.
Nvidia, Bitcoin, whatever it is, they're buying high. And then they're like, oh, that was a terrible idea. So low,
then they're selling low. Yeah.
You want to keep that. And then there's a psychological benefit of it, because when people don't feel safe. So one of my clients called it his NPA account, his never pour again money. And he kept a certain amount of muni bonds that he knew he was never going, like that was always going to be his amount of money. And he felt comfortable if he lost everything else that he had that money. And that's psychological benefit. And I think that it is unwise to divorce the human from the portfolio management, because the human controls the portfolio management. When you have that, you're able to withstand more market volatility and have a stronger stomach, because you're like, don't worry, if all else fails, I've got this. I could have the benefit of take. So those two components, your bonds and your stocks, just play a pivotal role. One just for making money, and one for being that ballast, that mental security, and that real portfolio negative correlation. But then if and when I can find investments, and this is where like you guys come in and where I've gravitated towards the work that you do, to have assets in your portfolio which are non-correlated. Like negatively correlated is beautiful. Non-correlated is really beautiful, because you have these components in your portfolio, which march to the beat of their own drummer. And if they serve as a secondary level of that ballast and a diversifier. And they are yet another thing in your portfolio that on days like yesterday in the stock market, they are doing exactly as they were the day before. And in the case of yours, they are cash flowing. So you are taking that cash and buying and buying down, or you're taking that cash and holding it with a note to buy lower, or whatever it is. And those investments are, in my book, are equally to, in some cases, even more attractive than certain bonds. Because bonds, municipal bonds pay what, 3.5%, tax-free, of course. But as you make the trade-off between, I need my money every day, so I need to keep it in bonds, or I don't actually need money to take out tomorrow. I have this huge bond portfolio, so I have room to lock something up for a little bit longer. Then you're able to toggle with that liquidity return give up. The more liquidity you give up, the more return you're able to accept. And so there you now have a stratification. You have one piece of your portfolio that is to negatively correlated, usually with the stock market, which is a pretty big piece. And that's liquid every single day. T+2, T+3 settlement, right? So like that's very liquid. Then you have that piece which people say, I don't want this to be as risky as the equity market. I want it to be non-correlated. I want it to produce money similar to the bond market, but I want it to have a higher return profile than 3%. And I'm willing to put money in the ground for a longer period of time to get that. Then you're looking at return profiles, which are, potentially 3 and 4x that, right? But still retain that cash flow component. And so if I could find a number of private investments which serve that role, or, to build those components into the portfolio, that to me is an ideal building block, because it retains that comfort. It retains that negative correlation to non-correlation, and it preserves that cash flow component, which is so important, especially underscored by the past 48 hours of why you want it.
What's the percentage of that piece? So you said 25-ish for bonds. What do you think percentage of that, the entire bucket? And then what else is in that bucket? Because I love to kind of hear different people's thoughts. And I have a lot of friends in different types of real estate and different private equity. It's like, but multifamily is kind of tricky right now. I'd just be curious to hear your thoughts on all that.
Retail is a challenge. Yeah.
How much would I put in that non-correlated bucket? So that non-correlated illiquid bucket, I would say my expectation would be 15% minimum. But if someone had a further appetite for further illiquidity, and we could find, most of the trouble is actually finding truly non-correlated investments, which have stood the test of multi-cycles, right? Because there's a lot which pop up. Bitcoin is very uncorrelated, right? It actually like increases the Sharpe of your portfolio up to a 3% allocation. But a lot of people aren't comfortable with that profile, right? Some people aren't comfortable with that because it hasn't had that time testing. Right. It hasn't had it. And so there's various things, but one of the components of real estate, which I have used just as an example of a component of real estate, and this is not really real estate, but it deals with land, is large scale wind and solar. And so wind and solar, when you put in large scale wind turbines, they work in conjunction with the already existing grids. And what happens in that case is effectively you own a physical asset, like similar to a building, similar to a structure. That asset depreciates. That asset cash flows every day where either the wind blows or the sun shines. You basically lock in long-term contracts with utilities, and so you're selling them for a contractual amount, that level of power, that level of energy generation. That is non-correlated because the wind doesn't care what the stock market is doing. It's blowing, it's not blowing. The sun is doing the same thing. It has no correlation to economic patterns. It has all correlation to weather patterns. When weather has a 3 standard deviation event, it doesn't coincide typically with market 3 standard deviation events. So it's a component of real estate where you can own the underlying land. You can or cannot, but you own the physical structure. You have that depreciation. You have that cash flow. And so in some senses, it functions very similar to the investments which you guys make, where you have a cash flow, you have depreciation, and you have underlying land value. It functions in some way similar to a municipal bond, where you have cash flow, but you have the depreciation. So you're able to effectively make it, call it like 75% tax free with that tax benefit, depending upon what your accountant says, of course, Surgeon General warning. But those types of things I really like, where you're like intuitively, like, I don't need a very complex formula to understand why that's non-correlated, and when you look at the volume and you have an exit plan, because once something has a history of a long cash flow, you're generally able to sell it to large pensions. They need components of their portfolio which are just cash flowing at a higher rate than bonds, but aren't terribly risky because they're insurance companies, things of that nature, which are looking to kind of different cash flows in different liquidity terms.
Sure. What about oil and gas? Do you recommend people play in that arena?
I feel commodities and currencies are in some, like in some cases, they're kind of the wild west of trading. Like because you can't model how the currency or a commodity in the same way you can a bond or a stock,
right,
or real estate investment.
Right? We love gold, and so because it just kind of, it's stood the only one to stand the test of time.
Mm-hmm. Correct.
We studied Ray Dalio and some of those other macro guys, Jim Rickards, and it's just like, that's our rainy day fund is gold in a vault
and some silver, because both metals.
And having a combination of bars and coins, because they're at different points in the economic cycle or the world cycle, things have different, like things replace different value, in time, during inflation, it's bars. During times of like intense geopolitical uncertainty, it's coins. It's something more fungible because you're not going to be shaving off pieces of that gold bar to, trade. But there's different things. And so yes, like those are the more, well, in the case of it in a vault, it's not as liquid, but in the case, in the case of it in some of the exchange traded ones, which are, and you have to kind of dig down into those because you have to see what they're backed by and what that just, you got to do your homework. But yeah, no, I think that having components of commodities, both kind of not in the energy space, in the precious metal space and in the agricultural space, they are all all fall into a component of more liquid investments, which maintain a low correlation to markets over the long run. I like them at the margin a little bit less than investments like yours and investments like the one I cited, only because they don't typically cash flow and they aren't as tax efficient. So people who are subject to very high taxation levels, there could be collectibles taxes or different levels of taxation. But from a standpoint of just purely from a diversification standpoint and things which either have stood the test of time or things which people require and use on a daily basis, agriculture, energy. Yes. I usually play oil, though. I will say the trader in me will play oil. I find it because it has such volatility, and
we're going to use it.
Right.
We're going to use the heck out of oil. I mean, it just seems like more and more now, the more we touch energy, the more we're the uncertainty builds, and the certainty of us consuming a lot of oil and natural gas is there.
Yeah.
It is. And it's also, can be very tied to if you, it's hard because oil is very hard to trade because sometimes it moves up and down depending on the macroeconomic sentiment. So if we feel unemployment is rising, the consumer is tapping out, you'll see oil adjust down. But if you begin to see any disruptions to our oil supply, to production, enter geopolitical conflicts, right? That will tend to rise. And so in some cases, you can use it as one of the only geopolitical hedges. Geopolitics are very consistently some of the hardest things to trade around. And it inspires a great deal of fear, but not a lot of abundant and obvious trading opportunities. So that can be a proxy, but one of the greater proxies I've found, and I watch oil markets in generally, here's where it's up 50%, here's where it's down 50%. Those are good indications to either take some chips off the table or maybe buy, because it's one of those markets that those types of fluctuations are normal. And so it satisfies the trader. I mean, I think a lot of people like to see you being opportunistic. When you have a portfolio and we're not changing this for the next 20 years. They're like, well, what good are you? You want to be able to actually.
You're supposed to be actively doing something.
Yeah.
I mean, yeah.
You want to be actively doing something. And that is a component where I have found nothing is easy. Nothing is easy, but I have found that to be that you can, with the right analysis, make consistent trades in that space.
Okay. But it takes active, trading.
Oh, yes.
And
I prefer, that's just my preference, that I prefer to keep a smaller allocation to those, to that component of the portfolio, but that's some of the more actively traded. Stocks are harder to actively trade because they've got usually such deep embedded gains and, and losses, and bonds you just don't really want to because the bid asks are big. So it's you want to trade things where you could kind of make some shots.
Yeah. Would you consider the oil and gas in that to be more of a high risk, versus a slow and steady?
Yeah. Put on your seatbelt. Yeah.
Right. Because you never know what's coming. Yeah.
Flight attendants, please sit down.
Yeah. Some turbulence is coming our way. Yeah.
Well, so what's the top portion? So I feel like we built maybe 50% of the foundational elements. Finish. Quick, let's quickly.
So 25 in bonds. If you have at least 15% in call it to negatively correlated. I would say that I have between 10 and 15% in more kind of like traditional private equity, and that ranges, from everything from like, from your venture capital to buyout, to special situations, to specific credit opportunities. So, kind of everything that falls into that private bucket. And that we could get very specific on, but I'm not going to drag you down into that rabbit hole. And that also has a lot to do. We start getting into what industry is the individual operating in, because usually people of substantial wealth have a component of their portfolio where they already operate in. And either you generally get one of two things. Either they feel a tremendous degree of comfort in that and they want to add to that, and that you cannot convince them otherwise. They're going to build on that, and their portfolio is almost going to be an extension of their body of work because they feel like they know it better. Or it's going to be completely the opposite. You're going to get a Texas wildcatter who has all their money in tech. Like I saw that a lot, that they want to invest in something else. Or you have the tech founder who only wants their private equity to be in early stage venture, or like individuals. So it can be both. But so that's where it gets that's where it gets a little bit personal. It depends on liquidity needs and what they're looking for, but it's generally call it, a mixture. And then the remainder is in equities.
Well, and that's what makes this so unique, right? Is like you just mentioned, like it is personal, and every person, depending on their background or their career, they make decisions different ways. So like knowing what like how would you do it? How would you put your own money to then, if the goal is cash flow, right? How would you define that? And how would you diversify to then gain cash flow for yourself and your family? And
because we really formulated this show and we called it the CashFlow Quest, because each one of us is sort of on this weird cash flow quest in that at the end of the day, you have to pay your damn bills with cash.
Yeah.
And you need the flow, and it's monthly, and it's like, I feel like there's very little conversation around the fact that is the end.
Right.
That is the end.
So whether it's retirement funds or investments on the side, or like Blake and I, we're building real estate portfolios. We believe wholeheartedly in that. But it's really interesting to learn what other people are doing. And, talking to you, we've learned a lot. But it would just, Blake and I are curious of like, knowing what and all the things that you've done and the career you've chosen, how would you get cash flow for you and your family?
This is what I've been thinking about the world right now. Like and this is honest in a portfolio. I would say, and let me just take it back like a couple months, because right now we're kind of in the throes of, I think we're in the throes of a transition in markets right now, but like, let's take it back 2 months ago. So 2 months ago, I was advising clients, to lighten up on equities. There was a lot of market pundits who were like, this is going to keep rolling, stay invested. And I cut risk in portfolios. So I cut risk in portfolios. I personally cut risk. I cut risk a good amount from where it was. And I put a component, I had a component in your strategy. I have, I switched from traditional municipal bonds to high yield municipal bonds because the rate of default is nearly indetectable between the two, but the differential in income is far higher. So I made that subtle switch where I still maintained what I consider to be a safe allocation, but I'm having it work harder for me because my anticipation was that the equity market was going to get rockier, and I wanted to build up more places where I'm getting a more consistent cash flow into my portfolios. So it was reduce equities, move that as a combination into strategies like yours, into bonds, switch the bonds from traditional to more higher yielding bonds. And then I what I like to do in my stock portfolio is I like to have a bit, like I try to have a bit of a barbell allocation. So if I'm going to own stocks, I traditionally don't own cash flowing stocks. I know that that's a big, it's a big thing for a lot of portfolio managers and for a lot of people. But I prefer to have my cash flow on the other side of the portfolio, and I prefer to have my risk in stock. So I really have this bifurcated, like I have a barbelled approach to risk. Like if I want cash flow, I'm going to get cash flow from you, where people pay rent and you collect it, and net of expenses, there is, and a transfer into my bank account of that level. That's cash flow, that unless you change the rents, that's not going to change, but dividends are something which is completely controlled by a company and can be changed at any point in time. And during an economic cycle, when things tend to get tighter, that can go, right. And so that's the last thing you want, is when times get tough, that level of cash flow. So I say, I just want, with my equity portfolio, I just want to be oriented towards risk. I want to be oriented towards things which can make me upwards of 10% on an annual basis. I'm willing to take the riskier components of the equity market in order to actually to justify the fact that I am kind of like in the middle of my investment career, from an age perspective, but I hold a lot of cash flowing instruments. And so the way I make up for holding a higher allocation to cash flowing instruments than someone of my age, and income level would suggest, is that I just barbell it a little bit more. And so that's how I get around. And that really works. Cause like when equities get rough, I'm like, yeah, this is exactly what they're going to do, but I'm going to put more money into this stuff. And when it recovers, when the equity market recovers, it goes and so you just have to have this kind of stomach of steel when things like that happen, and just know I've got a lot of cash flow coming.
Yeah. And take the risk so that there's reward, right? I mean, you're not going to get a lot of reward if you don't take some risk. So to have that barbell curve is kind of crucial to really have it's a good balance, right? You need that top of the curve to have that risk, to have the potential reward be there for the cash flow and growth for the portfolio.
Exactly. And I really do think of like the one half of my portfolio is for, like what you were saying is like everyone has bills. Like it's for kind of like the life management, either the psychology management of my life or the actual life management. And the other component I think of is like, I almost like think of it as a drop line item on the balance sheet. It's like stuff I'm going to revisit in 10 to 20 or 30 years, but like, please don't touch this right now. The only time you could touch it is if it goes way up and you want to, and you have like a really clear market feel that you should take some chips off the table. And I try to limit that, I try not to make like, I think certain people think like, oh, well, if you thought the equity market was going down, why did you hold any equities? It's just not it's not reasonable. Someone once told me at JP Morgan, the Stock Pickers Hall of Fame has no one in it, because it's so hard to consistently, the Market Timers Hall of Fame has no one in it. It's so hard to consistently do that. So like at the edges you can, similar to the discussion on oil, but you don't want to swing things around, especially with the tax implications. And because once you get out, you not only need to figure out when to get out perfectly, you need to get in. This is like a 2 decision thing to do it right.
Yeah. And analyze it such to where you get in and out at the right times for sure.
Exactly. Because a lot of people get out, they pay the taxes, and then they're like, and then the market, bottoms here, but they're still waiting. They're like, oh, it's going to go down again. They end up getting right back into here. It's like, well, that was.
Yeah. You might as well just hold because you paid the damn taxes.
Exactly. You haven't gotten anywhere. You were just, at best, you were swimming in place with a lot of mental gymnastics, but like, so there, it's high stakes to whip your portfolio around. And that's why I prefer a barbell. I'm like, just have something that works for me. It goes down, it goes up, and then have something that cash flows. And if I need to have dry powder to actually put in, when you're like, the market's down 25%, the market's down 35%. Let's just put stuff in that, historically, that's just been a good time to start layering things in. And
have fun with it, right? It's like, okay, look, it's looking like it's down. These historically have been really good performers. Like, let's have some fun and play here because we know it's down. Like it could be potentially a good time to play. What the heck? Like,
right.
Yeah.
And that I found is like a really good time. And I encourage all my clients to like, should I keep this portfolio of like funny money where I buy the stocks, which I like? I actually very much encourage them to do that because one, usually if you're buying something that you like and you believe in, you have a lot of staying power in it. Two, it kind of teaches people just, who are non-market participants, they're geniuses in other aspects of their career and life. Just, it kind of shows them, really gives them an up close, of how powerful the market could be, both on the up and down, but generally when people pick, I will say that in analyzing over the past 25 years, people's portfolios and looking at their kind of like funny money portfolios, those do really well. Because they buy and they hold things.
Yeah, we have a friend that put like 80 grand into Apple. This is probably 10 plus years ago.
Yeah.
And then he's like, turned into 12 million.
Literally. Yeah, literally.
Yeah.
Like, wow, that's pretty
those
cool.
Things you use. When I first went to Whole Foods when I was like 11 in Connecticut, and everyone was like all the rage, and everyone wanted to go to this new store, Whole Foods. I should have just taken my babysitting money at the time and bought it.
Right.
I mean,
no kidding.
And that's actually once my kids get older. I was literally thinking about that this morning. Like that, I want to start an E-Trade account, buy them just fractional, amounts of things that they like, just to.
Oh, that's a fun idea. Yeah. Like they like certain whole food items or they like certain toy brands.
There's like a flow to that. Like, why do they like it?
Right.
And like we were watching the show on NSYNC and the Backstreet Boys. The guy played into what the girls wanted, basically. And so they went crazy. Yeah. It's like, man, this guy was kind of a weird, evil genius. It's like, where are the 13-year-old girls? We're going to put these kids right in front of them and run them around. Like,
totally.
And
so crazy.
It's just that. It's like a common interest. And then that's what pulls the stock up or creates this like rage about it.
It's funny.
And elevates it. So it's really interesting.
All right, we can wrap it up because we've taken a ton of time and we really appreciate hanging with you and chatting and catching up. But let's have some fun. What do you think is going to happen? Yesterday was like a noteworthy day in the markets. Where do you think this goes? We got some crazy stuff for the next few months.
It's not going to be as optimistic. So let me just give you, over the long run, the optimists win. Over the long run, if you're optimistic, if you have confidence in yourself and you have confidence in the markets, you win. You win 9 times out of 10. You win 9 times out of 10 in the stock market every single day because you are betting on the ingenuity of the smartest people in the world worldwide to figure it out. And I will bet on that every day of the week, even when times get tough. Sure, at the beginning, you're caught flat-footed, but then you figure it out. You figure out how to do things more efficiently, how to do things with better people, and you adjust quickly. So that being said, like my long-term view is that you have to remain positive. You have to remain invested. You have to believe, in like the fundamental ability of humans to figure things out, because that at the end of the day is what has led to our consistent adaptation in this world. Having said all of that, I think we're in for a rough patch the next 3 months. I would be cautious, going into the fall. I think that the consumer is showing signs, and we're seeing this across the board. If you dig into some of the components of earnings, that there is a reticence to spend. And when that begins, then when there is a reticence to spend, then companies, the first thing that comes is companies miss earnings. The second thing is that they begin to shed staff. That creates a level of panic. The unemployment rate goes up. That leads to more curtailment in spending, and the cycle begins. I happen to believe that there is a component which is tied to the psychology of the price of your home, and that has remained relatively consistent. But to the extent that cracks, I feel like that could be another leg down in this cycle, and that has been really, I would say, a supportive bolster to sentiment, but with interest rates as high as they are for as long as they were. And you could argue that they've been a little bit too high for a bit too long. I think they were too low for a while. And now we may have swung in the other direction. And I think it is very hard to thread the needle using a blunt tool, the Fed funds rate. So I'm not discrediting anyone who works in that job, because they have a huge weight on their shoulders and they do amazing work. But I think we've maybe tightened a little bit too much. And to the extent that home prices begin to fall, that's a huge psychological impact. I also am looking at the components of commercial real estate and what that could do. Like, that could be a very big shoe to drop. And there, if you begin to see a weakening consumer, a weakening business environment, that I see as another potential risk. Layer in the fact that I unfortunately feel that the situation in the Middle East is going to escalate significantly further before it de-escalates, throws another shade of risk on the global macro space. And then, of course, we have U.S. elections, which honestly shouldn't really impact. It shouldn't really impact. And if you look at kind of the arc of history, it really doesn't impact markets in any.
We do this every 4 years.
Right.
Yeah. But the sentiment is that it does. And especially in ones which are, it does feel like there's a good deal of weight on this, and so I would say the market feels like there's a significant amount of just pressure. And I mean this kind of like from all components, in all directions right now. So I think it's best to have a plan. One, like I always say, markets will do what they do. They go up and they go down. This is not abnormal. But what you need to do is, if we're going into a market cycle, which is on the downturn, which is what I believe we are in, you just need to make sure that you have a plan. From where will you be taking cash? At what levels, and where are you investing it into the market and into what? And start having those conversations now. I am having 2 conversations within the next, call it 15 minutes to an hour, on exactly that. So like, this is the time. And truly, like, these should be, if you're doing it right, the second conversations that you're having. The first conversation was, we should be bolstering a little bit of cash, and where is it? And so these actually for us are the second level of the conversation, which is, we've got the dry powder, where will we be going? And at what levels? And so those are the conversations which I'd be having now.
I love it.
Amazing. Yeah.
That was fun.
That was so fun. Thanks so much, Heather, for being here and for sharing all of that information. This was really fun. Good information.
Oh, I love talking to you guys.
Thank you so much.
And always so good to see you.